Unit 1. Calculating and reporting various taxes. In this section, you will receive the information on the topics that FDI advisors should become acquainted with, the theoretical framework of the tax system in the Republic of Slovenia, and the method of calculating and reporting various taxes. After reading this unit, you will become familiar with the concepts of profit tax, income tax and value-added tax. Get to know the foundation institutes of the taxation system of the Republic of Slovenia. Accounting tracks the business process and takes place in compliance with accounting standards by applying the legal regulations of a particular country. Further on we will take a look at tax regulations in the Republic of Slovenia and their application in the system of accounting of entrepreneurs, through the following parts. The fundamental features of the Slovenian tax system. Profit tax. Income tax. Transfer of taxpayers to income tax inside the profit tax system. Value-added tax. The Slovenian tax system is based on a system of direct and indirect taxation. Direct taxes represent the income of a state that can either be paid by an individual personally or by his employer. Taxes are calculated as a certain percentage of the realized income or assets, which in Slovenia includes profit tax, income tax and surtax on income tax. Indirect taxes are those taxes where the tax burden of taxpayers is borne by the end user through the price of a product or service, and in Slovenia there is value-added tax, excise, custom duties and real estate tax. Legal entities operations, income of residents and non-residents are taxed. Residents are taxed according to the global income taxation and are liable to pay tax on all income having its source in Slovenia and income that has a source outside Slovenia. Non-residents are obliged to pay income tax only on income from sources in Slovenia. Taxes represent the revenue of a budget and are settled for the purpose of settling the public expenditure envisaged by the budget. Pursuant to the Constitution of the Republic of Slovenia, it is the obligation of each individual to participate in settling public expenditure in accordance with their own economic capacity. The general tax law categorizes public duties on taxes and other public revenues that include duties, the form of tax charged on the import of goods or services, fees, money for the use of a certain public good or payment of a particular act, contributions, giving for the purpose of using certain services for the exercise of certain rights, concession fees, fines for tax misdemeanors, and all allowances, the determination, collection and/or supervision of which fall under special regulations, and within the remit of the tax authority. The Corporate Income Tax Act is the underlying regulation governing the issue of profit tax. This act regulates the system and introduces the obligation to pay corporate income tax. The taxpayer is a tax-paying company or other legal and natural person who carries out the economic activity in the Republic of Slovenia, tax resident of Republic of Slovenia, on an autonomous and permanent basis and for the purpose of obtaining profit, income or revenue or other economically accessible benefits. From the balance sheet perspective, profits represent the difference between equity before taxation at the end and at the beginning of the period. Likewise, profit can also be defined from the perspective of profit and loss of an account, as the positive difference between realized income and expenses in the accounting period, on the basis of the law and in accordance with the accounting standards. Profit tax is a tax based on the difference between income and expenses. In English terminology it is called corporate corporation income tax. The difference between income and expenses or gain realized in the accounting period is the basis of profit tax. From the tax perspective, profit before tax, or gross profit, is the tax base increased for previously non-deductible expenses and reduced for deductions and relief, in accordance with the provisions of the Corporate Income Tax Act. Thus, there are certain differences between the accounting results of the financial results from the point of view of tax regulations, which represents the tax base, that are reflected in revenues and expenditures and may have the characteristics of permanent and temporary differences. An entrepreneur included in the system of profit tax is obliged to manage his business books and to compile reports in accordance with the state regulations and accounting standards, which implies the application of the principle of dual bookkeeping. The tax period is usually the calendar year, although at the request of a taxpayer another tax period of up to 12 months can be determined. Tax on profit or loss from ordinary activities is determined at the rate of 19% on the tax base, which is the accounting profit determined on the basis of data from the business books of the trading company and the financial statements prepared in accordance with the accounting regulations, corrected for the prescribed deductions and increases. Deferred tax is neither a tax nor a deferred tax. As a matter of substance, it would be more appropriate to name it the tax that is fully charged. It reflects differences between the carrying amount of assets and liabilities and their tax base. When a corporation has an accounting expense or income over a period of 1 year and when calculating a corporation tax in another year, the deferred tax must be recognized for those differences that are taxable and deductible, recognized by the principle of materiality. In Slovenia, the standard rate of income tax is 19% and 15% for general corporate profits tax. More detailed information about the profit tax can be obtained on the web pages of Financial Office of Republic of Slovenia. There are two types of income taxes, corporate business and personal income tax. The Slovenian tax system is residential and corporations have full corporation tax liability. The tax residence criterion for legal entities is the seat of incorporation, meaning that the headquarters of the company must be based in Slovenia. A company can be considered a tax resident if its central management and control is exercised from Slovenia, although the actual seat might be situated in another country. Regardless of tax residence, it is possible for authorities to impose a tax on companies' incomes if the source of income is Slovenia, according to the income source approach. When doing so, the national tax authorities observe relevant tax treaties, in order to avoid double taxation. Most of the company operating a business in Slovenia have to pay corporate income tax. The general tax rate in Slovenia is 19%. Corporate income tax does not apply to a sole trader operating as an individual. If a business conducts trade in Slovenia, but its head office is in another country, it is tax due on income sourced in Slovenia. Possible tax returns are submitted in electronic form via the ETIC system. In order to submit the form via electronic tax system, the company has to obtain the appropriate digital certificate. The annual basis for tax calculation is usually the calendar year. Companies that prove their business is seasonal by nature can be exempt from this condition. The same goes for subsidiaries of multinational corporations that dictate a different year base than the calendar year. Regardless of the timing shift, the non-calendar year must comprise of 12 months and must be kept for a minimum of 3 years. Personal income tax rates in Slovenia apply only to sole traders and individuals that perform business activities in Slovenia. The Slovenian income tax prepayment calculation is made according to the income tax rate as defined in the tax schedule, from 16% to 50%. Income from self-employment is income obtained from performing any entrepreneurial or independent activity. If the head office of a company is in another country but operating in Slovenia, it is obliged to pay tax on income earned in Slovenia. The tax return for the prepayment of income tax must be submitted to the Tax Administration Office by the 31st of March of the current year for the previous year at the latest. The document must be submitted in electronic form via the ETIC system. The return does not have to be submitted by those sole traders and individuals who hold the status of a person paying normalized taxes. Depending on the type of the business entity, there are two ways of determining taxable income. Standard corporations are required to present the earnings minus the calculation of tax-recognized costs, which is based on financial balance sheets. The surplus is taxed at a 19% rate. A tax loss is carried forward, which allows the companies with an annual capital loss, deficit, to offset the taxation of capital surplus in the future years. The presumed costs of companies with normalized expenses amount to 80% of their income, regardless of factual information. This system is designed for small businesses, net income. The fundamental principles of value-added tax, VAT, are: basically, VAT is a tax on consumption, which means that VAT is ultimately paid by the final consumer in the form of a percentage supplement to the final price of goods or services. VAT is charged only to those buyers of goods and services that do not have the right to deduct VAT, which is mainly citizens or final consumers. It is indirect tax because the supplier of goods or services, taxable person, pays VAT on goods or services to the National Tax Administration after deducting the VAT already paid to suppliers. This is an all-inclusive tax payable for each service delivered and for each supply of goods from the added value added. It is a turnover tax, which means that it must be accounted for when the turnover has been made and in certain other cases which are determined by the ZDDV1, for example, non-business use. One of the essential features of value-added tax is to ensure fiscal neutrality among taxpayers. Neutrality for the taxable person, the buyer of goods and services, means the right to deduct from the tax liability the input tax charged by the suppliers in the tax period. VAT is one of the forms of turnover tax used to tax goods and services in all turnover phases, from producer and trader to end consumer. All persons must report to the tax authority when they start to carry out an activity as a taxable person, and if certain conditions are fulfilled, submit a request to receive an ID number for VAT. A person or entity becomes liable for VAT when annual turnover exceeds €50,000. When this happens, an application for the issue of a VAT identification number must be registered in the month when turnover is likely to exceed the annual threshold of €50,000. An individual or a business can apply to become VAT registered even if its turnover does not reach the threshold. An application can be submitted when the company is being set up on condition that the applicant remains a taxable person for at least 60 months thereafter. VAT is subject to added value. VAT is one of the forms of sales tax, which is subject to taxation of goods and services at all stages of transport, from producer, trader to final consumer. It is a consumable form of value-added tax which is subject to taxation of goods and services at all stages of the exchange. In principle, the taxable person levies and pays VAT on every supply of goods or services, or from transactions that are regarded under the VAT legislation as supplies of goods or services, with the exception of certain specified transactions which are exempt from VAT. In accordance with Slovenian VAT legislation, VAT is charged and paid for supplies of goods or services at a general rate of 22%, except for the supply of goods and services for which a lower rate of 9.5% is set. The list of goods and services to which a reduced rate of VAT is applicable is contained in Annex I to the ZDDV1. A person or an entity wishing to register for VAT must apply for a VAT identification number by submitting an electronic form via the ETIT system, PDAVKI, or the EVIM portal to the Tax Administration Office. The entire process of registration for VAT in Slovenia can also be carried out at a point with free assistance from a specialist. To review Form DDVP2. Based on the submitted application, the tax authority identifies the person or entity for VAT purposes. A VAT identification number is assigned which consists of alphanumeric characters, with the first two indicating the country the business is registered in, SI for Slovenia, and the number itself. The Slovenian tax authority issues the VAT identification number by no later than the last day of the month following the month of application. Every taxable person identified for VAT purposes is obliged to submit a VAT return. A VAT return must be submitted for each tax period separately, whether the person or entity is liable to pay VAT for that tax period or not. The deadline for submitting a VAT return is the last business day of the month following the end of the tax period and in some cases even earlier. The DDVO form may be sent to the tax office only in electronic form through the ETIT system. Use of the e-tax system requires a digital certificate. Taxable persons identified for VAT must fulfill certain obligations determined by the VAT Act, ZDDV1. In certain cases, vehicle acquisition must be reported to a tax authority. The delivery of a new vehicle to another member state must be reported to the tax authority. Acquisition of means of transport from another member country is subject to VAT taxation in Slovenia. The exemption of taxes for diplomatic and consular posts, agencies and European Union authorities, as well as international organizations in compliance with international agreements binding on the Republic of Slovenia can be claimed as direct exemption or paid tax refund. A taxable person without a head office in Slovenia who occasionally carries out international road transport of passenger with vehicles that are not registered in Slovenia cannot claim the VAT deduction or refund, and if he does not carry out any other transactions subject to VAT in Slovenia he can use a special regulation for these services. Taxable persons who provide telecommunications services, lease services or electronic services to persons who are not liable for tax may use a special regulation for services that are carried out under another regulation. In case of VAT, the latter is levied for each participant in the chain and at the same time the VAT is deducted from this amount that was included in the production factors in previous stages. Thus, in fact, only the difference between the tax charged at the next stage or the final consumer and the tax charged for the purchase is paid to the budgetary fund. In particular, this means that the VAT charged on issued invoices is reduced by the value of VAT charged on received invoices for goods and services that are directly related to your business. Indeed, the taxpayer does not actually pay the state the tax he charged on issued invoices, since he can deduct from the tax the invoice charged in received invoices, even when importing and in the case of self-taxation. Taxation of transactions with real estate property with VAT. A taxable person performing transactions for which VAT exemption is set out in points 2, 7 and 8 of Article 44 of the ZDDV1 may can be the tenant, the lessee or the buyer of the real estate, taxable persons entitled to the deduction of the total VAT to be charged VAT on the prescribed rates from those transactions which should be exempted from VAT. Of the transactions listed above, VAT is charged if they submit each of their statements. When talking about investments, it is essential to know the tax benefits related to the profit tax. Considering the number of tax reliefs, it is good to know the relevant provisions of the Income Tax Act.